Good afternoon and welcome to another edition of Unlock the Stock. We really are pleased today to welcome back to Unlock the Stock, Lesaka Technologies. As you all know by now, Unlock the Stock is a platform which is specifically designed for retail investors to gain access to corporate management and to get to know the company and their management just a bit better. Lincoln Male, the CEO of Southern Africa, and Naeem Kola, the Group CFO, join us from Lesaka Technologies today, and they will take you through a presentation shortly. Unlock the Stock is only possible with our technology partner, Lumi Global. Please visit their website at lumiglobal.com to learn more about their various online AGM and investor presentation solutions. Our host today, as usual, will be the finance ghost, Mark Tobin, of Coffee Microcaps, is taking a well-deserved break overseas. So the finance ghost will facilitate the Q&A session at the end of the presentation. Before we start, there are just a few housekeeping notes. Lincoln and Naeem will take you through a presentation which will be followed by a Q&A session. You can post your questions by typing it into the Q&A box at the bottom of your screen. The event, as usual, is being recorded and will be available on our Unlock the Stock YouTube channel next week. You will see an email address when we begin the Q&A session. If you would like to be added to Lesaka Technologies contact database, please jot down that email address and send them an email and ask to be put onto the database, please. Lincoln, that is all from my side. So I am ready for you guys to share your presentation and take us through it. Thank you.
Thank you, Vanessa. Thank you, everybody, for joining, and thank you for the opportunity to share a few thoughts on our business. My name is Lincoln Mali. I'm the CEO for Southern Africa for Lesaka. I've been in Lesaka for 3 years, and before that, I was at the Standard Bank Group for 20 years. I'm joined by my colleague, Naeem Kola, who's our CFO. But I will clarify some of the changes that will take place in the business later on. Now, what brought me to Lesaka was a passion for financial inclusion, to try and find ways in which technology and innovation and data can solve some intractable problems that are being experienced by the underserved, whether they be underserved consumers or underserved merchants. And so what we've tried to do at Lesaka is to build an ecosystem where we can have a platform that services merchants and that services consumers. And we're driven by this idea that we could enable merchants to compete and grow, and at the same time improve the lives of South African grant beneficiaries. That's been the organizing philosophy of why we would want to build a business like Lesaka. Now, we have announced a major transaction where we are acquiring Adumo. Adumo is South Africa's largest independent payment processor. This is a business that's been around for more than 20 years. We are so humbled by the opportunity to work with our colleagues at Adumo, Paul Kent and his team, and the new organization that will emerge from this will have about 3,300 employees. We will now have a combined total of about 119,000 merchants, and we'll be able to process more than 250 billion rands in throughput a year. This changes fundamentally what Lesaka was. The organization that we have today is going to be very different from the 1st of October when this transaction is concluded. What I thought I could do is to give you a sense of what the new organization would look like when we now have the combined entity. We have for a long time organized ourselves in 2 segments, consumer and merchant. Now we're going to organize ourselves around 4 customer types and 4 divisions. If I start at the top, we're going to have the consumer division. The current Lesaka division has got 1.5 million active customers. They'll now be joined by 250,000 customers from Adumo payouts, and that will now have 1.7 million active customers from the 1st of October as Lesaka as our consumer division. The next division is the micro merchant division. This is where we deal with sole traders. This is where we deal with spaza shops, taverns, and so on. And this division will be led by my colleague Martin Wright. And in there, you'll see prominent brands like Kazang, together with TouchSides, which is a data and analytics company that we brought earlier this year. Where the coming together of Adumo and Lesaka will really happen at the merchant division. This is a division where we deal with small and medium businesses, small and medium merchants. And that is where our Connect businesses, the Adumo businesses, and the GAP businesses will come together. We now will have a very interesting entry into the hospitality vertical, where GAP is quite dominant. This will now give us 29,380,000 merchants and a throughput of 133 billion rands per year. And this is where the largest competition will take place with the financial institutions. The last division is the enterprise division. Just on the merchant, Paul Kent, who is currently the CEO of Adumo, will take over and run that division, the merchant division. And then enterprise division, that's where we deal with large organizations, telcos, banks, and so on. We have about 750 clients there, and a throughput of about 70 billion rands. And you'll have brands like EasyPay and Prism in that space. Now, the context of why we do what we do has to be seen within what is happening throughout the world. If one looks at the seismic changes and shifts that are taking place in the merchant businesses across the world over the last 10 years, the profile in terms of profitability, size, scale, and impact has shifted from traditional banks to merchant businesses or fintechs. You're starting to see more fintechs coming through and being able to compete with banks by providing more holistic and compelling value propositions. In 2011, there would have only been 3% of organizations that were in the global top 50 of acquirers. In 2021, 10 years later, 52% of the top 50 acquirers are now non-banks. When you go further and look at this by different geographies, you see this trend continuing. 2014, when you look at by market cap between banks and fintech, you see all the large banks that we all know, Itaú, Santander, and others in Brazil, and there was no fintech to speak of in 2014. 10 years later, you see that 39% is now occupied by large fintechs, like PaySaguru, Nubank, and others. If we shift our focus to Egypt, again in 2014, there would have been no large fintech in terms of market cap in local currency. 2024, now 21% of fintechs are starting to play in that space and be competitive. And that is where you see players like Fowry, Network International, and so on. If you take it closer to home, to Nigeria, again in 2014, you would have had no large fintechs featuring there. And then in 2024, you have 68% of players being fintechs that compete with the large banks. And now you start to see players like Flutterwave and others. When you bring it to South Africa, 2014, there were no large fintechs featuring in terms of market cap in local currency. But in 2024, only 5% of businesses are starting to feature. That is where Time, Lesaka, Mukuru, Yoko, and them are featuring. And this is driven by the regulatory environment in South Africa, which has not moved in the same manner as the other countries. But we see huge changes that are being driven by the Reserve Bank that now will allow non-bank participants to settle and clear without having to be a bank. We see proposals to regulate non-banks either as payments organizations, very different from how you would regulate banks. We welcome these changes. We think that they will give impetus for non-banks to be able to compete directly in that space with the incumbents. So when you bring this together, some of the non-banks or fintech I showed earlier are examples of organizations that we want to emulate. These are organizations that have built an ecosystem of consumers and merchants that have been able to compete with the incumbents. We think that South Africa does not have a platform of that size and that nature. And what we've been trying to do is to build the largest fintech in Southern Africa. We want to build an end-to-end platform that provides solutions for both merchants and consumers with a keen focus on cash and the digitization of serving the underserved. That is the business case that we're building. And so on this journey over the last 3 years, we've been driven by the organizing principle that we can be a natural consolidator in this market and we can build a scale to be able to compete. This is further reinforced by the latest research that shows that Africa is poised indeed to be the fastest growing fintech market globally. And we can see the level of growth that is expected of the continent. And we think that we want to be part of that growth. And it's fueled by the digitization of commerce that is happening in a number of countries, and I think is also happening in South Africa. So in terms of our focus, for a large part, because we were turning around the business, we had focused on the South African business. We have now cast our eyes more broader to be in other jurisdictions. So with this Adumo deal, we will be in South Africa, we will be in Namibia, Botswana, Zambia, and Kenya. That gives us a bigger addressable population that we can focus on. And it gives us a larger GDP that we can focus on as an organization. These are the wins, that are fueling the growth that we see in our business. So I'm going to hand over now to Naeem. Before I do want to say that we've made an announcement that we are making changes in our leadership team. Naeem, who's been our CFO, will now move to a new role of a COO. And this is necessitated by the changes that are taking place in the business as we've acquired the Adumo business and the other acquisitions that we've got in our pipeline. Naeem will be looking at synergies across the group, building a product platform that we can consume internally across the group, making sure that there are cost and revenue synergies across the group, and making sure that all the other areas in the group, be they operations, be they legal and compliance and risk, all of them are being looked at with the full group in mind. He will be replaced by Dan Smith. Dan has been with us from his role as a director at VCP, Value Client Partners, our major shareholder. He will start on the 1st of October to replace Naeem as CFO. And then Steve Helbron, who has been running our merchant business, will focus on M&A and corporate development. And then I will continue my role as CEO for Southern Africa. So this team that we have now under Ali's leadership is really, really focused on driving the underlying businesses, but also create opportunities for inorganic growth. And the team has got the experience to not only acquire businesses, but also integrate them, as we've done with the Connect Group 2 years ago. This new acquisition of Adumo gives us new possibilities and new, synergies that we can have in driving that business forward. So I'm going to hand it over to my brother Naeem.
Excellent. Thanks, Lincoln. Thank you, everyone. Just for us to go through the financial highlights.
Yeah, there we go.
Excellent. I think as Lincoln has highlighted, the organization over the last 24 months has been very transformational. The acquisition that we did with the Connect transaction has redirected our merchant business, and we can see that directly from the performance and the turnaround in terms of our group adjusted EBITDA, and as well as the consumer business, where we inherited a business that was significantly loss-making from an EBITDA perspective, losing almost over 400 million, and also burning cash in excess of about 500 million a year. Those two businesses together with our consumer and merchant business, as you can see, has been very transformational for us in terms of our group revenue. FY23 versus our FY24 performance is 11% increase. And if you look at FY22, it's a significant change, but that's driven mainly by the acquisition of the Connect Group. So with the modest growth in terms of group revenue of 11%, the impact that we've had on group adjusted EBITDA, which is both a strong indicator of performance as well as a strong indicator of cash generation, has transformed from 2 years ago, where we were making a loss of 328 million, to being a profit of 691 million in the current financial year for FY24. And that's a growth of 55% year on year. And a significant contributor of that growth was the turnaround of our consumer business, which delivered around 274 million of group adjusted EBITDA. The benefit of that has come through on our operating income line, where we've gone from a loss of 611 million 2 years ago to being positive 67 million in our current financial year of FY24. So a lot of the changes and the turnaround that we've done in terms of both redirecting our merchant business as well as the consumer cost savings is coming through in terms of financial performance. I think, as Lincoln has highlighted, is that with this base now being created, the focus is really on growing the business both from an organic and an inorganic perspective. The Adumo business will be contributing to our overall performance and will be fairly important for us in terms of the scale and the markets that we cover. And I'll touch on that from a perspective of the guidance that we've given that includes the business. I think the other points to highlight is that in the current financial year, we generated 538 million of cash from operating activities versus 7.5 million the previous year. We've also reduced our leverage ratio to 2.5 times as of the end of June. A year ago, we were at 4.5 times. This is a combination of managing our debt position, but also our EBITDA growth over the period. The other point to highlight is that we've got about 1.4 billion of non-core assets on the balance sheet, very specific to the MobiKwik investment that we hold. And again, this is an opportunity that we will be looking to exit this position at the right time and the right opportunity, but it's basically would be funds that we would use for reduction of debt and for growth expansion within the organization. I can just touch on the... So we just look at our outlook. We've put our outlook for the financial year FY25. We have a June financial year. Both from a revenue perspective and a group adjusted EBITDA perspective, we've gone for the quarter as well as for the full year. Our full year guidance is an outlook of between 10 to 11 billion. I think it is important to highlight that from a revenue perspective, there's a significant impact that we have in terms of our airtime sales within our VAS and merchant business. There's been quite a change with one of our suppliers in terms of the supply and the pinless airtime, which is looked at on a net basis versus the gross basis. So if you look at the revenue growth, it does look modest, but if you adjust for the impact of that change, the growth is more in the region of about 15 to 16% year on year. On a group adjusted EBITDA, we were looking to go from 691 million to a range of 900 to a billion. At the midpoint of that range, the growth is about 37% increase, and that includes the Adumo performance for 9 months of financial year FY25. If we exclude the Adumo base and just look at the core business, we would be expecting our core business to grow by about 25%. That also includes a change where on our consumer business, there's an interest recognition of the interest cost on our consumer loan book. If we adjust for that, we will be growing this business by more than 30% from a pure core business in terms of the operational side. Lincoln?
Just to conclude, as Naeem said, we've been in the turnaround. Our focus now is on growth. And what we are looking at is to have the team that we've got now with Ali as executive chair, the 4 of us in the group role, myself, Naeem, Dan, and Steve, and then the 4 P&L owners. And that's a leadership team that we've got to drive the business to the next stage of growth. So thank you for listening to us, and we are very happy to take questions.
Thank you so much, Lincoln and Naeem, for that update. Very, very exciting things that lie ahead, it sounds like. So without further ado, I'm going to hand you over to the finance ghost, who's going to take us through the Q&A session. Just for everyone on the call, please remember to jot down your question in the chat function and send it to the finance ghost, please. Thank you. Over to you, Ghost.
Thank you, Vanessa, Lincoln, Naeem. Thank you very much. The 2 of you are in an enviable position right now. I think this is a very exciting group to be working in, to be playing this role in. So yeah, I'm looking forward to seeing how it goes over the next few years. I'm quite an emerging markets fanatic myself. I mean, I still live here and I love living here. So I really enjoyed those slides where you included those other countries as great examples. So tired of seeing South African companies point to the first world and the developed markets and say, hey, we can go make money there. I love it when people point to markets that are a lot more like ours. And it just talks to the size of the prize there and the level of the opportunities. So that's where I want to start, which is just understanding on the acquiring side, how are the fintechs disrupting the banks? Because, for someone like me, I read it and I can see that, a merchant can choose various different ways to get paid. I've always wondered what the key differentiators are from one to the next. Is this just a case of allowing merchants to actually start to take these digital payments and previously they were running on cash? Or are these disruptors and yourselves actually displacing the banks? Someone is choosing you and getting rid of a bank in the process. I'm very curious to understand which one it is. Maybe it's both.
Okay. So I think it's, as you highlighted, I think it's a combination of both. Right? I think it's the key focus for us as an organization and for a number of fintechs, which you'd see in the developing markets, is the focus for merchant base that has not been serviced. So when we say merchant base that has not been serviced, is that there's a large amount of them in terms of the merchant base in the informal markets, as well as, sort of the lower tier merchants where the banks typically focus very much in terms of the tier 1, tier 2 merchants and don't have financial solutions for the lower base informal merchants. And I think for us, the driving factor that we've seen in other markets is the technology capability that we're able to go to these merchants and basically propose to them the capability of having a system that helps them to manage stock, a system that helps them to manage their payment flows, not only from a card perspective, but a cash perspective and a card perspective, so it gives them an overall view. And then the ability for them to enable payments through a wallet or through a digital platform, whether it be a mobile wallet or through a wallet that we manage, that enables them to do payments to their main suppliers. So I think where we found that our ability to compete and to be more effective than the banks is the more bespoke capabilities that we build around the market segments that we service. And the second thing is that the ability that a lot of the banks have older latent technology. The thing is, the technology and the platforms that we use are more suited for this. And the third thing is the approach to market. Our sales teams are focused on servicing these customer segments, whereas the banks are very much focused on the tier 1, tier 2 models that they do. With that being said, our personal belief is that there is a high level of collaboration between fintechs and banks. And if you look at the markets where fintechs have been successful, the banks have allowed fintechs to work together with them. And let me give you an example on that, is that although we focus on the lower segment markets, there's a big demand for credit. The ability for the banks to actually tap into that, utilizing our capabilities to underwrite the loans for them, is an opportunity for them to grow their asset base. So these are things that work very closely together. The other area for us is the enterprise function that we've set up within our organization. In order to work closer with banks, the technology that we develop and some of the services that we create, we would be working through banks, through our enterprise division, to actually facilitate them to service their tier 1 and tier 2 merchants. So I think there is an opportunity for both to work together and to allow fintechs to service a market today that's underserved.
If I could just add, just a theme from Naeem is, in some aspects, we will collaborate with banks. In some aspects, we'll compete. What we're trying to do from a regulatory point of view is to support the changes that are being proposed by the Reserve Bank in order for them to level the playing field so that non-banks can compete. But where banks would want the tech from non-banks, we must be able to do that as well. We've come together as a group of merchant businesses across South Africa, and we've created a body that is now engaging the Reserve Bank as one group. There are 8 companies in this group, and that group is probably 98% of the merchant market outside of banks. And that is Lesaka, Altron, Ikoka, Yoko, Network International, Hello Pesa, Peach, and Network International. We've created a body called the Association of Payment Providers. So again, that's where we are engaging the regulatory authorities to say we support the changes that are being mooted. We want the process to go even faster, but we're not doing that as anti-bank. We're doing that because we think that society can benefit from the opening up of the system, as we've seen in Brazil, as we've seen in India and other markets. So where we need to compete with banks, we'll compete, but where we need to collaborate, we'll collaborate.
Thank you. That's super interesting. So, some of these emerging markets, obviously South Africa is still very much an emerging market. Then you've got a few African countries up there, which are almost your more frontier markets in many ways. I was thinking of some of the flywheels for growth, and I just wanted to run them past you and see if I've missed any. So, population growth, that's got to be one. That's something that developed markets at the moment it's actually negative at the moment in many places, not so in emerging markets. Inflation is another one. I would imagine that inflation is good news for you because you're ultimately taking payments, and that means you're processing payments, which inevitably is going to be a percentage of what people are spending. So inflation, I would imagine, is a relatively net positive unless it's running at crazy numbers, in which case it hits volumes. Then you've got stuff like digitization of cash. So people just using more and more cards. Urbanization is another one I thought of, which is just people going to more of these areas. And then the final one would be discretionary spend. It's that story of the rise of the middle class in Africa and access to FMCG type goods. That's me basically building your bull case because I like the business, But would you say that those are the flywheels? Have I missed one? Is there something else that's very top of mind for you?
I'll just add 2 other things. They are a subset of one of the things you've mentioned. So if you just think about the the business we've acquired, which is Tatsides. It's got data analytics of what is happening real time in the informal market. So more and more companies are going to want to invest or buy goods or do business with the informal market. But because they have no visibility, it makes it very difficult. But what we've got now is our POS devices give such data analytics real time that a large FMCG comes to us and buys the data to understand the investment decisions that they have to make into that market. Or a large, let's say, cigarette company can make those, or a milk company can make those decisions. The other one is the payments between a small merchant and a large entity. Rather than people using cash now, sitting in their shop, they can now do supplier payments, pay for the goods, get a QR code, and then the goods are delivered and no cash is exchanged. So all of those use cases are building into this. And if you look at the slide, you look at the growth in throughput of supplier payments, which has increased by 100% compared to financial year 2023 quarter 3. So a lot of these FMCG and companies are now saying this helps us to be able not only have the eyes but also to be able to receive payments from the informal market. And the more those payments happen, the more data that we're collecting, and the more people are getting comfort to do more deals or to much more longer term business. And that drives more business success in the informal market as well.
Great, thank you. And then I think just for people to understand exactly how you operate in that value chain, I mean, you're not disrupting the Visas and MasterCards of this world, right? They still get their money from people using the payment rails effectively. The bank is going and issuing cards, and people are using those cards to pay on your device that sits at the merchant. So I just want to make sure that that's firstly understood by me, but just by everyone else as well. Is that an accurate statement? You're not actually taking a fee that would have gone to a Visa and MasterCard, right?
Yeah, so look, I don't think, definitely we're not taking a fee that would have been gone to Visa and MasterCard. I think what we are doing is we're expanding the network for Visa and MasterCard. So we work very closely with the schemes as well as with the local partners being BankServe to basically expand the network that enables acceptance. So they actually getting a lot more access points, and both Visa, MasterCard, and a number of the global schemes have certain incentive programs because they want to reach the lower tier markets. They want to reach the underserved merchants as well as underserved customers. I think where we are disrupting and where we are changing the market dynamics is that before, as Lincoln highlighted, where a merchant would be sitting with an amount of cash, which has security risk and has a lot of other issues related to it, we are digitizing that cash into a wallet, and we're enabling that merchant to make direct payments into its supplier network. That creates efficiencies both for the supplier in terms of their cash collection, but also creates a level of security and safety for their drivers, that when they do the delivery of stock or when they do the delivery of items, they're purely delivering the stock and not cash. So that enables us to control that ecosystem, digitize cash, but also enables us to earn a fee, which both is on the merchant side as well as on the supplier payment. So it gives us a broader capability and gives us the ability to then reduce the cost of those transactions that we do. And then I think the second thing is more what we refer to as the embedded payment capability. So providing a merchant the ability to have the acceptance of payment cards, cash, VAS, and a number of other products and services, and to manage that under one on one system. So that ability to reconcile and understand the flows that comes through. And through that capability, we build on our credit products where we can actually credit score a merchant on a much more efficient basis to enable them to access credit facilities.
I'll never actually forget, it was a few years ago in my formal advisory career when someone told me the story of how the bread delivery trucks really operate in township areas and how they're basically just a cash in transit vehicle by the end of the day. And it was shocking for me, but also when you think about it, it's so obvious. I mean, how can it be any different? And you see I'll never forget that terrible video on social media where the drivers were, attacked in the vehicle. It was terrible. And just taking cash out the system and digitizing it has a genuine, I think, human impact here, which is obviously
Absolutely.
really powerful. So in terms of the different, verticals that you're now organizing your B2B business into, your merchant business, do you think there are bolt-ons to be done in terms of bolt-on acquisitions, like across all those verticals? I mean, you've talked about being a consolidator. Ultimately, that's kind of the role you're looking to play. Do all the verticals have those sort of opportunities to continue doing acquisitions out of interest?
We are looking at a number of targets, and the targets we're looking at are to be found in all the divisions. The key question for us is always going to be, if we're looking at an acquisition, it's got to be EBITDA accretive. It's got to give us scale. It's got to give us a product, broader product set and solutions, and must also probably extend a bit of our geography to the markets that Naeem was talking about. We have had the same capital allocation committee since 2021. They're quite strict about how we deploy capital. So we will be looking at bolt-ons across, but it is also possible that other big transformational targets would be in the picture. So the next few months, we're going to be looking at all of those. And that's why we have a team that can run the day-to-day business, but also be looking at these possible deals, but also be able to integrate those into the business to create one business that's always driving and always growing. So there's a lot in the pipeline. There's a lot of thinking about it. Phil has just put up the team. We just don't have Dan there, so Dan will be the next person who will be our CFO in Naeem's space. Ali, our chair, has built these types of businesses in different markets, in Asia, in the Middle East, on the continent, and he's done that in Europe as well. And similarly, working with Naeem in those, some of those transactions. And Steve, that ran our, merchant business, is now going to be solely dedicated to corporate development and M&A. So as a team, that's really going to be our task. And then our colleagues who are the CEOs are going to be focused on those divisions and make sure whatever we acquire, we can integrate and kind of make work in the day-to-day running of the business in a division.
Awesome. I've got a question here in my DMs about the consumer side of things, and that's just around the payments of grants. So it was just a question around, do you have any more data around like the number of grants you're paying per month, volumes, etc.? I don't know if you have any of that close at hand, but there's some interest in those sort of stats, if you can share them. And then what I think is quite an interesting question, which is to ask whether the current political climate, so obviously the GNU, is a threat or an opportunity to that side of the business. So there's an interesting question for you.
Cool. Let me start with, firstly, when we joined 3 years ago, there was still this notion of paying grants. And so the organization that we inherited was a grant dispersing organization. We changed it to become a sales and service focused business that is focused on the customer, that we want to win each and every customer and provide them with solutions and then try and retain them. We're to train, let's go back, we're to train all of our staff from scratch to sell all of our solutions. As we speak now, the environment has changed dramatically from what we had 3 years ago. Capitec is now the market leader with 31% market share. The post office has been losing clients, given all of their challenges. We are sitting at 11% of grant beneficiaries. In terms of how we operate, yes, Phil? In terms of how we operate, we don't just pay grants. The grant is paid the grant is paid into an account, and the client then has an opportunity to access their grant through an ATM, a POS device, or get a point of sale, cash at the point of sale. You look at the number of accounts we've been able to activate, about 326,000. Those are gross activations. And then after churn, we've been able to activate about 192,000 customers. That's like 143% growth. But also because we've trained our staff, you can see in the middle of the picture, we have a growth of 20% in terms of those customers who've got a transactional account with us, but have a loan with us. But then we've also grown 30%, those customers that have got our transactional account and an insurance policy. But if you look at those clients that have got a transactional account, have got a loan with us, and have got a policy with us, that's grown 35%. So if you look at this next slide. So if you think about just the growth in loans, next one, yeah. So if you just see the growth in our permanent customers, these are permanent grant recipients, not SRDs. That's grown 21%. If you look at our loan book, that's grown 32% year on year, and we still have a very low loss ratio of below 6%. And you look at our insurance, that's grown by 31% year on year, and the collection rate is about 96% when the industry is operating at about 60%. And we have a lapse ratio of about 7% when the industry is at about 20%. And you just see the ARPU growing from 80 rands to 90 rands. So this business, that's the last slide. This business has been, just give me one more slide. The business has turned around, completely. If you just look at the segment adjusted EBITDA, growing at 361% from last year. And again, if you take it back to 2022, that was a loss of 329 million rand. So for us, we see this as a growth business. We're still focused on social grant beneficiaries, but the Adumo transactions gives us a new customer base, which are not social grant beneficiaries, 250,000 people who are employed, who get their benefits, let's say in a mine, and they've got a safety target, and they meet it, and they are paid through that card. So those 250,000 customers will be customers that we can test whether our lending, whether our insurance, whether our VES, can work in that base. So we are no longer just thinking of ourselves as a social grants business on the consumer side. We think there are pockets of underserved that we can be able to, give attention to going forward.
Let's talk interest rates maybe in the subject, or rather in the context of some of the financial products that you're offering and loans to, I think, consumers and merchants, if I understand the business correctly. So interest rates, let's hope that the SARB is going to deliver some good news today. I'm certainly hoping so, being led by the Fed. I guess time will tell. It's good news for most of us. I'm curious if it's good news for you. Do you think that a decrease in interest rate environment is a net positive for you, or is it a challenge?
I think it will be positive. I mean, Naeem might add, if I ask her to look at that credit, the merchant lending piece, the medium-sized businesses we were lending to have had all the inflation, high interest rates, load shedding, the work. And so we've seen muted growth in that environment because some of our clients could not meet our criteria. We've been able to maintain the quality of the book. But now, with the changes in interest rates, we think that we can be able to see growth in that space. I think the positivity that is coming with GNU, I think some of the positive sentiments in the country and in the economy will add, to some of these businesses wanting to grow their businesses, extend, their shops and things of that sort. We think that will be at our advantage. On the consumer side, it's a slightly different picture. There is no direct correlation between what happens with the interest rates in that space and what happens with the quality of the book. We've had our loan loss ratio being below 6% over the last 3 years. We've seen some uptick in risk, but still very, very low and nowhere breaching that loan loss ratio that we have. So, but of course, any decrease in interest rates does help other parts of the economy, and therefore our consumers will also benefit. But we think that the biggest benefit will be in the merchant space. And then on a larger point, we are signatories to the commitment or pledge by CEOs at the end of last year to assist government on those aspects of government that we needed to work in society, like transport, like focusing on crime and corruption, like the energy piece. We think that as businesses, we've got to always support the government of the day. And we are also keen to support the current government to find partnerships between business and government to make sure that society does benefit and the country does prosper. So for us, the positive noises and the positive sentiment that's there with the GNU, we are very hopeful that it starts to feed into the real economy. And I think and hopeful that a change in interest rates will also go in that same direction.
Thank you. Yeah, I've got some interesting comments in my DMs just around people are going to be watching your revenue mix over time, which is obviously your consumer versus merchant. And, the more disclosure on that, the merrier is kind of the feedback coming through, which is awesome. Something I have to make sure we cover in the time we have is my personal bugbear with US tech companies. So I have to ask, and that's around the use of adjusted EBITDA. It's very much the market standard in the US, and I get it. And it's all about reversing out share-based payments and then doing share buybacks to try and limit the dilution. All the US tech codes do it, and I understand that that is part of your audience. From your side, how do you think about just managing that dilution for shareholders over time of potentially having those significant stock-based compensation charges, how that impacts adjusted EBITDA? I guess just some thoughts around, maybe the question is, over time, how do you protect shareholder interests alongside making sure you've got the right staff, etc.? Because it's a balancing act, and I get that, especially in a business like this with a high growth trajectory. That's why these stock-based compensation charges are there. It's to try and get the right team in place and get them to believe in the big story. But just any comments you might have on the use of adjusted EBITDA, because it's actually not that common in the South African market. We're very much a headline earnings IFRS game, as you know, as opposed to the way the US thinks.
So look, I think specific to adjusted EBITDA, and I think it's it's sort of on the worldwide basis. If you look at fintechs and tech companies, to your point, is that that generally has always been a case in terms of adjusted EBITDA. And the specific reason for that is the level of investment that goes into the platforms and the technologies that fintechs build, and to enable investors to look at the cash generation of the business versus the depreciation impact on that. So I think, again, a number of investors that we speak to and that are exposed onto the fintech or the technology industries have been looking at it from a adjusted EBITDA or EBITDA basis versus, if you look at a traditional bank or some of the larger multinational traditional organizations, which look at it more on headline earnings and EPS basis. The second thing is in terms of the share-based costs, right? So look, I think the share-based costs in the current P&L looks higher than what we would want it to be, but it is also on the basis that a lot of the executives, the key staff that we had to bring into the organization, needed the incentive in order to build the platform that we're looking at. So, within a year's time or within 2 years' time, that would be a significantly smaller percentage of EBITDA. And that's purely based on the fact that the focus on this year and a lot of the incentives that people have is based on growing the EBITDA and the business and the net profit of the business. So I think over time, that impact would become a lot more smaller purely because the incentive that you grow is sort of linked to what you deliver, right? So the current position is slightly skewed, and it's mainly because of accounting conventions, where both in US GAAP and IFRS, there's a certain treatment requirement for recognizing the SBC. It's not linked to your actual delivery of EBITDA, profitability, and share price movement, but it's built onto the commitment that the company has. Whereas if you look at the underlying incentive only vests if certain criteria in terms of EBITDA and share prices are met. So, that potentially could be a cost that doesn't even come into fruition if actually we don't meet the numbers, but becomes a lot smaller if you actually beat your targets and deliver on your numbers. So I think, in an organization that's growing, it is a nuance that we've got to deal with in the early days, but that becomes a much more smaller percentage as we deliver on what we're committing to in terms of growing the business.
Yeah, I mean, in fairness to technology companies, the accounting rules are not very kind to you in terms of stuff landing on the balance sheet. The big sort of manufacturing businesses, they have huge balance sheets, and tech companies, everything gets expensed, even though they're building an asset of value. It's an interesting discussion point globally on how these accounting rules actually work. So thank you for that. Something else I want to ask you just on the numbers, just some of the momentum into Q4. It does look like there was a little bit of a slowdown versus full year. Now, that may well be base effects. So just on lines like adjusted EBITDA, I think when I looked, fourth quarter growth just looked a little bit lighter than the full year. Is that base effects of acquisitions, or is that, it was just a slower quarter? I mean, obviously that would have covered, I guess, the election period and some of that kind of stuff, which was an awkward time in South Africa. So I'm just trying to understand sort of your exit velocity into your new financial year.
Yeah, sure. So look, I think, again, I think there's a few things that we'd highlight as part of this year is that, especially in our merchant business, what you would see is that in the consumer business, quarter on quarter, the growth has continued to be very robust and strong. And that's sort of really talking through the process in terms of the cost savings, the right sizing of the cost base that we've done has fully come in by Q2, and Q3, Q4 has been a bit more normalized. And the focus on that has been growing on the revenue side of the business. Within our merchant side of the business, there's a few things to highlight is that as we redirected the business, there's certain business areas, for example, a big part of our FY23 versus FY24, as well as the quarterly, included hardware sales of POS machines. As an organization, we've made a conscientious decision that hardware sales of POS machine is not a focus for us. The focus for us is developing the technology that runs this and managing that technology. So over the last year, that has come down on a quarterly basis and has an impact on the fourth quarter. And I think you'll see that normalize and grow into that. The other thing is that, there are opportunities in the market with regards to bulk VAS purchases, and these are very much opportunistic in nature. So there might be 1 or 2 quarters where there's more deals on the table and opportunities that we can fund, and that helps us to enhance our margin within certain periods of time. And the third point is really, what you indicated is that on the cash side of the business, because of the elections and because of the environment that we've seen people trading, we've seen quite a slowdown in our capital book growth. And this wasn't us changing our credit criteria, but a number of merchants that used to meet the credit criteria because of lower performance were no longer meeting the credit criteria. So we took we didn't want to extend our credit or adjust our credit to take undue risk. So, there are the areas that we're looking into. I think for us, the core business in terms of our underlying VAS, so if you look at airtime, electricity, there's a lot of other capabilities that we built onto that in terms of bill payments. So the product mix has been changing, and that there, and that's on the screen right now, is that you can still see that's still growing by 43% year on year. It's also growing quarter on quarter very strongly. So the underlying core of the business is growing very strongly. The digitization of cash in the merchant space moving on to card continues to grow strongly. So those focus areas for us in terms of the core side of the business is where we focus on. And then the second thing is that the product capability that we're trying to build around the merchant, around our merchants, is driving our ARPO. So increasing our ARPO versus, only increasing the merchant base.
Thank you. I think time for one more question, and then we can probably call it, Vanessa. So just around how you guys allocate capital, I'm just curious, do you look at it and is it a case of saying each product needs to stand on its own feet, or is there a broader ecosystem way of thinking here? Because that's what's so interesting with your business, right? Is everything you can do to encourage digitization of cash in lower income areas is probably going to land in a till that involves you somewhere. So I'm just curious, it's a nice place to end off. How do you think about the ecosystem spend versus specific product and capital allocation and all that kind of stuff?
So look, I think from a capital allocation perspective, there's a few things that we look at, right? So a big driver of our capital allocation is our CapEx spend. And our CapEx spend is very focused on growth CapEx. And that is largely allocated to our merchant business side, because that's where we see the highest growth in terms of opportunity. And what I'd like to highlight on this here is that if we look at the two merchant businesses that we have, and sort of the informal market from a Kazang perspective, because of the product capability that we have. So when we put a point of sale machine in a merchant, we're not only enabling acceptance of a payment transaction, but we making that point of sale a revenue generator for that merchant, where they can sell airtime, enable bill payments, they can do supplier payments of it. Those capabilities give us a higher revenue that we earn off that. And if you look at our payback period, it's between 3 to 4 months, and the useful life of that machine is 36 months. So there's a significant IRR on those allocations. Our cash vaults, to certain degrees, have a longer payback, but have a much more longer lifespan. So we're a bit more conservative on the growth on that base, and it's very much based on how we're seeing the market growth. Specifically in that area, we're allocating towards our tier markets. And then I would say on a broader basis, a lot of our capital allocation is based on opportunistic. So we do keep a bucket of capital for when there's opportunities for bulk VAS purchases or opportunities to get increased margin on that. And then separately, the third bucket we look at is more the expansion from a bolt-on acquisition opportunity in terms of what we allocate for growth.
Thank you so much. Before I let Vanessa come in, I just want to commend you on that choice of corporate color as well. The purple is clearly a great choice. And more than that, just to thank you for the great engagement today. I really, really enjoyed it. So thank you very much.
Thank you so much.
Thank you to the Ghost and to everyone who chose to spend time with us today in this session, but a special thank you to Lincoln and Naeem. This really has been a fantastic conversation. So thank you very much. We hope that everyone who's been on the call has enjoyed it. As a reminder, it will be recorded and available on the Unlock the Stock YouTube channel next week. And then our next session of Unlock the Stock will take place on Thursday, as usual, 10th of October. And that features another returning company, which is Pan African Resources. Thank you, everyone, and goodbye.